Welcome to Sheen Research, your strategic partner in comprehensive investment analysis.
Today, we are digging into Strategy Inc.'s latest quarterly filing. We've got the Form 10Q for the period ending September 30, 2025.
And this document, it's really something else. I mean, calling it a traditional financial report feels like a huge understatement.
It's more like the blueprint for a financial engineering experiment, and one that's operating at just a massive scale.
Exactly. Our mission today is really synthesis. We have to understand this tension between two completely different identities in one company.
Right.
You've got the traditional, evolving enterprise analytics software business on one side.
And on the other, this colossal, highly leveraged digital asset treasury reserve policy.
So we need to get past the surface numbers and really scrutinize the mechanics. I mean, the massive shifts in the financials, the capital market activities. We need to capture every material numerical fact to understand what this means for you, the investor.
Because this isn't just a tech company anymore.
No, not at all. It's fundamentally a high-velocity, multi-billion-dollar capital deployment vehicle.
That dual identity is absolutely the key to interpreting this filing. The sheer magnitude of their treasury operations. I mean, we just have to start there.
Agreed.
So Section 1, we're jumping straight into what we're calling the Bitcoin balance sheet engine.
Good name for it.
Well, the metrics that engine generates, they fundamentally redefine the valuation and the risk profile of Strategy Inc.
Okay, let's start with the top line. Looking at how it compares to the just seismic shifts in profitability, we're comparing Q3 2025 versus Q3 2024.
Right. And the core software business is healthy, but its growth feels, almost academic compared to the impact of the capital strategy.
So what are the numbers? Total revenues in Q3 2025.
They reached $128.691 million.
Okay, so that's a solid increase. What's the year over year on that?
That's up 10.9% from $116.071 million in the third quarter of the prior year. So, respectable growth.
And if we zoom out to the year-to-date picture, for the 9 months.
For the full 9 months ending September 30, 2025, the trend is stable, but a little more moderate. They brought in $354.245 million.
Which is an increase of what, about 3.5%?
3.4%, exactly. Up from $342.759 million in the same period in 2024. So this just signals that the software segment is delivering, reliable top-line growth.
Reliable, if unspectacular.
That's the word for it.
And the gross profit tells a pretty similar story, right? About the operating unit's efficiency.
It does. The quarterly gross profit looks strong. It came in at $90.678 million in Q3 2025.
So an 11% increase year over year, that basically mirrors the revenue growth.
It does. But when we look at the entire 9 months, the narrative on gross profit, it changes completely.
How so?
The YTD gross profit was essentially flat. We're talking $246.511 million this year compared to $247.460 million in 2024.
So that's actually a small decline, minus 0.4%.
A marginal decline, yeah. And this flatline performance is, I think, really critical. It highlights that while they are successfully migrating customers to those higher margin cloud subscriptions,
Which we'll get into.
right, but the transitional costs,
Yeah.
things like increased cloud infrastructure expenses and the initial dual costs of maintaining legacy support systems, those are just eating away at any margin expansion.
So the software business is going through a really costly structural evolution right now.
It is. But all of that, all that operational detail, it gets immediately annihilated when we look at the bottom line.
Yeah, this is where the numbers get wild. The most dramatic market-defining figure is what we're calling the net income loss chasm. And it's driven not by software, but by the digital asset strategy and the new, very favorable accounting standards.
Annihilated is exactly the right word. The net income swing is astronomical. We're talking billions.
So for Q3 2025, what's the number?
The company reported a massive GAAP net income of $2.785 billion.
$2.785 billion. And to get a sense of the scale of that turnaround, what was it in Q3 2024?
In Q3 2024, they had a massive net loss of $340.174 million.
So a swing of over $3 billion in one quarter.
And it gets even more dramatic when you look at the year-to-date. The entire financial structure of the company has been completely inverted.
Okay, lay it out.
Year-to-date 2025 saw a net income of $8.588 billion.
$8.588 billion. And that's coming from a loss in 2024 of...
A year-to-date 2024 net loss of $495.851 million.
So you're talking about a swing of over $9 billion in GAAP profitability, all without selling the underlying asset. I mean, that is the entire story of this filing.
And that $9 billion swing brings us directly to Section 1.2. This is the mechanism that enables all of this reported performance.
The impact of digital asset accounting changes.
Exactly. We need to be crystal clear on this shift. The company adopted ASU 2023-08 on January 1st, 2025.
Right. And let's just pause and explain what that actually means for our listeners. Before 2025, under U.S. GAAP, digital assets were basically treated like intangible assets.
Right, on a cost basis model.
Meaning if the price of Bitcoin went up, they couldn't report a gain until they sold it. But if the price went down, they had to report an impairment loss immediately, which crushed their reported net income.
It was a chronic source of losses for them in 2024. It was this heads I lose, tails I don't win until later accounting model.
And ASU 2023-08 changed all of that.
It changed the game.
Yeah.
It requires digital assets to be accounted for at fair value through earnings, which means they now have to mark the value of their holdings to the current market price at the end of every quarter.
And the unrealized change, the gain or the loss, flows directly into the income statement.
Directly. And that change fundamentally alters the reported financials. Under this new rule, the company now recognizes those massive unrealized gains as a non-cash reduction of operating expenses.
That's the key part. It's a non-cash gain. What was the number for Q3?
For Q3 2025, they reported an unrealized gain on digital assets of $3.890 billion.
So that non-cash gain of almost $4 billion is what essentially manufactured the net income we just talked about.
That's one way to put it. Think of it this way. Their core operating expenses were reduced by nearly $4 billion on paper in just 3 months, simply because the value of their Treasury holdings went up.
And the year-to-date impact.
Truly staggering. An unrealized gain of $12.032 billion recognized over the first 9 months of 2025.
And the beauty of this, from management's perspective, is the contrast it creates with the past.
Oh, absolutely. In Q3 2024, under the old rules, they were forced to take digital asset impairment losses of $412.084 million.
And year-to-date 2024, that was what, almost $800 million?
$783.807 million in impairment losses. And now, in Q3 and year-to-date 2025, those impairment losses are zero.
So this single accounting rule change transformed a chronic drag on GAAP income into this enormous source of GAAP profitability.
It did, and strategically, that gives management tremendous optical flexibility. They are now a company that reports positive, multi-billion-dollar GAAP income, which is very useful for capital market optics and maybe even future regulatory or listing requirements, even if the income is non-cash.
And that massive valuation feeds directly into the total asset growth. The balance sheet expansion here is... it's breathtaking.
It is. Total liabilities, mezzanine equity, and stockholders' equity grew from around $25.8 billion at the end of 2024 to a colossal $73.619 billion as of September 30, 2025.
So it nearly tripled in 9 months?
It did. And this magnitude, it just reflects the fair value accounting of their holdings. I mean, Bitcoin now represents the vast majority of their assets, $73.205 billion worth.
Right. And we always have to remember, as they state very explicitly in the risk factors, these assets are highly concentrated and subject to extreme volatility.
Absolutely. This near tripling of the balance sheet completely re-rates the enterprise. You're not just investing in a software company anymore. You're investing in a highly leveraged Bitcoin investment vehicle that just happens to own an enterprise software company.
Okay, let's move to 1.3. The metrics management uses to judge its own success. Bitcoin holdings in Bitcoin per share, or BPS.
Right. So as of September 30, 2025, the company held an astonishing 640,031 Bitcoins.
640,000. And that accumulation didn't stop at the end of the quarter, did it?
No, we have a subsequent event update. As of October 30, 2025, the total holdings had grown a bit more to approximately 641,167 BTC.
And the market price context here is just fundamental to the whole story.
Absolutely. The Bitcoin price on Coinbase at September 30, 2025 was reported at $114,378.
Which is a huge appreciation, up sharply from just $63,463 a year prior.
And that's the price that gives us the $73.2055 billion carrying value on the balance sheet.
And the pace of acquisition has just gone vertical.
It's accelerated dramatically. They acquired 42,705 BTC in Q3 2025 alone.
42,000 in 1 quarter. And year-to-date?
Year-to-date 2025, they accumulated 192,561 BTC.
And how does that compare to 2024?
Well, if you compare that rate to 2024, where they acquired 25,889 BTC in Q3 and 63,070 BTC year to date, you're seeing a massive, almost threefold acceleration in the pace of accumulation.
And that's fueled entirely by the financing strategies we're about to get into.
And-
Which brings us to the centerpiece of their whole reporting strategy, Bitcoin per share, BPS.
This is their KPI, their key performance indicator. It's designed to measure accretion to shareholders, and it's calculated as Bitcoin holdings divided by assumed diluted shares outstanding.
It's a very unusual metric. It's measuring physical accumulation relative to dilution.
Right. The metric is trying to show that their capital raising activities, which inherently create dilution through stock issuance or convertible debt, are increasing the Bitcoin exposure faster than the dilution they are incurring.
So what was the BPS number?
As of September 30th, the BPS was 199,984 Satoshis.
And that's up significantly.
It is. It's an increase of 41,158 Satoshis year to date, up from 158,826 at the end of 2024. This numerical increase is the central proof management offers that the leveraged Bitcoin strategy is working.
But, and this is important, we have to introduce some critical tension here. While BPS is a useful measure of accumulation relative to dilution, it completely ignores two massive components of risk.
First, the cost of that leverage, the interest payments, the preferred dividends, and second, the volatility of the asset itself.
Exactly. If BTC falls, the BPS might stay high, but the dollar value of that accretion could just plummet, which could trigger a crisis in their access to the capital markets.
So it's a fantastic metric for signaling commitment and execution during a strong bull market.
But it's completely silent on the financial stress tests that are required during a prolonged downturn. They also break this down using BTC gain and BTC dollar gain metrics.
Okay, what were those?
The Q3 2025 BTC gain was 31,058. That's substantially higher than the 11,535 BTC gain they reported in Q3 2024.
And in dollar terms?
That 31,058 BTC gain translates into a massive dollar figure for the quarter. The Q3 2025 BTC dollar gain was $3.552 billion.
Compared to just $732 million in Q3 2024.
And again, that rapid escalation in dollar value is driven by two things.
Yeah.
The sheer volume of BTC they acquired and the sharply increased market price of Bitcoin. Management is just running the accumulation machine at peak capacity.
So the bottom line on Section 1 is that the company has fundamentally transformed. The software unit is now the foundation, a slow growth, positive cash flow generator, but the valuation and the financial results are completely dominated by the Treasury strategy.
And that strategy is driven by aggressive leverage and very favorable accounting adjustments. The primary objective is maximizing Satoshis per share, even if it requires, unprecedented financial engineering complexity.
Okay, so having covered the behemoth that is the Bitcoin Treasury, let's pivot back to the operating business, the software business, because this is the core value driver that actually generates the cash flow and justifies the underlying enterprise.
Right. Section 2.1 is focused on segment performance, specifically that critical cloud transition.
And this transition narrative is key to understanding that flattening gross margin we saw earlier.
It is. The strength and really the future viability is absolutely in subscription services. This revenue stream surged 65.4% in Q3 2025.
At what level?
It hit $45.972 million, up from $27.800 million.
That's robust growth, and the year-to-date numbers confirm that momentum.
They do. YTD growth was also 65.5%, reaching $123.899 million. The company says this is from successful conversions of on-prem customers migrating to the cloud and new sales contracts.
Which is exactly what a mature enterprise software company needs to be doing right now.
But that cloud focus, it creates friction and volatility in the legacy revenue streams.
You mean product licenses?
Look at product licenses. Revenue for Q3 was $17.373 million, which looks like a strong 56.7% increase.
But there's a catch.
A big one. Management is very transparent that this strong quarterly performance was primarily due to fees from a significant one-time settlement.
So if you strip out that one-time fee, the underlying trend for traditional licenses is still negative.
And the proof is right in the year-to-date numbers for product licenses. Revenue actually decreased 4.5% to $31.820 million. This just confirms the long-term trend that the cloud push is actively cannibalizing traditional license sales.
It's a necessary trade-off for long-term recurring revenue stability, but it shows the legacy business is shrinking.
And the clearest, most quantifiable evidence of this strategic transition is in the product support segment.
Because that revenue is tied directly to the old on-prem licenses.
Exactly. Product support revenue dropped sharply, 16.2% in Q3 to $51.118 million.
And 16% year-to-date.
Right, down to $155.728 million. And the filing explicitly says this decline is because customers are converting to cloud subscription services. So this isn't a problem. It's a necessary, healthy transfer of revenue from a declining model to a growing one.
Even if it hurts the absolute top line today. And this conversion also impacts how revenue gets recognized. We need to look at deferred revenue.
Right. Total deferred revenue decreased by $38.9 million since the end of 2024.
Which, on its face, sounds concerning, since deferred revenue is future recognized revenue.
It sounds concerning, but we need to look closer. The contraction is primarily from the decrease in deferred product support revenue, which is expiring as customers switch to the cloud.
But critically,
the current deferred subscription services revenue increased to $109.763 million. This reflects the successful booking of those new, ratably recognized cloud contracts.
and they give good visibility into future performance, too. The remaining performance obligation stands at $462.4 million.
With $280 million of that expected to be recognized over the next 12 months. This gives the software segment a predictable, substantial, recurring revenue base.
Which is crucial because this is the operational engine that has to service the preferred dividends and the debt interest.
Okay, let's move into 2.2 and analyze operating expense management and the cost structure. Because to achieve that flat gross margin while undergoing this costly transition, the software business had to show extreme cost discipline, specifically in personnel.
And the cuts are deep and strategic. Sales and marketing S&M expenses decreased 15.5% in Q3 to $29.908 million.
And year-to-date, they were down 11.6% to $91.131 million.
Where did those reductions come from?
Mainly two things: decreased average staffing levels and equity forfeiture, though they were partially offset by commission increases related to higher sales volumes.
Which is actually a healthy sign. You're cutting administrative headcount but paying more to successful salespeople.
Exactly. But even more drastic were the cuts in research and development, R&D.
What were those numbers?
R&D decreased a staggering 32.1% in Q3 to $22.602 million. And year-to-date, it was down $23.602 million, again tied to staffing cuts.
Mostly, yeah. Offset slightly by increased cloud hosting costs for their own internal development.
This is a huge strategic insight. A 32% cut in R&D in one quarter. That's not fine-tuning. That is a structural decision.
It is. It suggests management has decided the software business is shifting from being a primary engine of cutting-edge innovation to being a highly efficient, cash-generating harvest operation,
They're prioritizing customer migration and retention over expansive new product development.
freeing up operational cash flow to support the main thesis, Bitcoin acquisition. And that shift is perfectly contrasted by what happened with G&A expenses, general and administrative.
Right. While S&M and R&D shrank, G&A expenses increased 13.9% in Q3 to $38.173 million.
And 10.5% year-to-date.
To $115.220 million. And this increase is the literal cost of running the Treasury.
You mean custody fees and things like that?
It's driven primarily by higher Bitcoin custody fees, advocacy expenses related to the digital asset space, and the public filing costs that come with constant capital raising. Look at the hard numbers for custody. Digital asset custody fees alone were $5.342 million in Q3 2025.
And that's up from, what, just $1.7 million in Q3 2024?
It's up from $1.746 million. It's a massive leap.
So they're achieving massive savings, arguably through underinvestment in human capital and R&D, saving tens of millions.
But those savings are being partially replaced by the soaring cost of institutional custody and the financial complexity of running a multi-billion-dollar treasury. The company shifted its cost structure from being intensive in human capital and innovation towards being intensive in financial engineering and asset custody fees.
The core function is now to feed the asset engine.
And the entire viability of that engine depends entirely on its ability to execute Section 3, capital markets and liquidity. If they can't raise capital, the Bitcoin acquisition stops. The BPS metric stalls.
And this Q3 filing confirms that the capital raising machinery is, for now, functioning flawlessly.
Absolutely. Q3 2025 saw massive capital raising activity, a total of $5.1 billion in net proceeds.
$5.1 billion, and that's a mix of equity, preferred stock, and debt.
That's right.
$2.618 billion from equity and preferred stock plus debt issuance.
And the year-to-date figures are just staggering. It confirms the company's status as a capital machine.
YTD 2025, the company raised total net proceeds of $19.7 billion.
Almost $20 billion injected into the system in 9 months.
And that $19.7 billion breaks down into roughly $12.9 billion from equity and preferred stock instruments.
Plus another nearly $2 billion from the 2030B convertible notes.
$1.985 billion from those notes, plus other funds. But that figure, $19.7 billion, that is the fuel that allowed them to acquire those 192,561 Bitcoins this year.
Let's break down the equity side, focusing on the common stock at the market, or ATM, offerings.
Right. And for listeners, an ATM offering is essentially a continuous, opportunistic equity issuance program. Instead of doing one big secondary offering, they can just trickle shares out into the market whenever the stock price is favorable.
It's the perfect instrument for what they're doing, continuous, high-volume accumulation.
And they're using it aggressively. Q3 ATM sales generated $2.199 billion in net proceeds.
And year-to-date?
Year-to-date, those ATM sales generated $11.847 billion in net proceeds. That is an enormous reliance on the primary equity market to fund asset acquisition.
And critically for investors, the firepower is not depleted.
No. As of October 30, 2025, the company still has a massive war chest ready to deploy. The common stock ATMs still have $15.854 billion in available capacity.
Which just signals that management is fully geared up to continue this strategy indefinitely, as long as the market cooperates.
Now we get into the really complex part. The preferred stock instrument portfolio, Section 3.2. This is financial engineering at its most intricate.
They've issued 4 distinct series of perpetual preferred stock just in 2025.
STRF, STRC, STRK, and STRD. And this complexity is necessary to target different investor appetites. Some want fixed income, some want variable rates, some want convertibility, all to raise capital without immediate common stock dilution.
So focusing on Q3, what were the proceeds from the preferreds?
Total net proceeds from preferred stock issuances were $2.895 billion. The lion's share, nearly $2.5 billion, came from the initial issuance of the STRC stock.
That's the variable rate one.
The variable rate series, a perpetual stretch preferred stock, yeah.
Yeah.
It brought in $2.473 billion net proceeds during the quarter.
And the rest is split among the other instruments.
It is. The STRF stock, which carries a 10% fixed rate, brought in $217.434 million. The STRK stock, which is fixed at 8% but it's convertible.
Right, convertible to classic common stock at 0.1 shares per STRK share.
That generated $152.824 million. And finally, the STRD stock, a 10% fixed, non-convertible preferred, contributed $48.462 million.
So what's the cost of servicing this complex stack?
It's substantial. Total preferred stock dividends paid in Q3 were $139.781 million.
And almost $200 million year-to-date.
$197.922 million year-to-date. This is a significant and rapidly growing recurring cash obligation that the software segment has to help meet.
And there was a major and I think fascinating insight into management's execution here with the variable rate STRC stock.
Yes, the active handling of the dividend. The filing highlights their decision to proactively adjust the rate to manage the market price.
They increased the dividend rate from 10% to 10.25% effective October 1st.
And then they increased it again to 10.50% effective November 1st.
Why are they micromanaging a 25 basis point change? I mean, this is a critical liquidity management mechanism.
It is. The company explicitly states the rate adjustments are intended to keep the price of the STRC stock near its $100 stated amount by adjusting the yield.
So if the stock trades too far below par, it signals stress in the market about their ability to pay, which hurts future capital raising.
Exactly. By keeping the yield competitive, they stabilize this massive variable rate funding source. It demonstrates an almost real-time management of their financing costs.
Okay, let's move to the debt structure and conversion activity in 3.3.
The long-term debt overview shows a total principal due upon maturity of $8.24 billion. This is a massive liability commitment that they have to address eventually.
$8.24 billion, and that's aggregated across 6 different series of convertible notes.
The 2028, 2029, 2030A, 2030B, 2031, and 2032 notes. This debt is also a huge source of past capital, and they did successfully clean up the 2027 notes earlier this year.
Right, the $1.05 billion worth. They were converted or redeemed in Q1.
And the potential future dilution from these notes is an important factor in that BPS metric.
What's the maximum number of shares?
The max number of Class A common shares potentially issuable upon conversion is 26,048,630 shares.
That's the ceiling on how much more dilution the existing debt structure can impose if the stock price stays high.
And what about the immediate cash impact, the interest expense?
Interest expense, net, in Q3 was a manageable $18.890 million. It's up slightly from Q3 2024.
So while it's modest compared to the unrealized gains, it still represents a tangible cash drag of roughly $75 million annually on top of the preferred dividend obligations.
So to sum up the liquidity needs, short term, you've got working capital, CapEx, those hefty preferred dividends, and about $17.3 million in semi-annual interest on convertible notes.
But the long-term needs are dominated by that substantial $8.24 billion debt principal repayment.
Right. And the challenge here, which BPS doesn't capture, is the rollover risk.
Yeah.
If they have to pay back that $8.24 billion when Bitcoin is flat or declining, they would face immense difficulty refinancing that debt, especially with a B credit rating.
The whole debt strategy relies on either being able to convert the notes to equity, which requires a high stock price,
or continued access to capital markets for refinancing.
Okay, let's move into Section 4. The critical external factors, regulatory environment, and market risks that could impact this whole model. Let's start with a major regulatory breakthrough that significantly de-risked the entire accounting strategy.
The CAMT update in 4.1.
Yeah, this was huge.
This was, without a doubt, the single biggest systemic risk hanging over the company after they adopted fair value accounting. The Corporate Alternative Minimum Tax, or CAMT.
Which imposes a 15% minimum tax on large corporations if their average annual adjusted financial statement income, or AFSI, exceeds $1 billion over 3 years.
And given the enormous multi-billion-dollar unrealized gains they were recognizing, Strategy Inc. looked like a prime candidate to get hit by this tax on their non-cash gains. It could have made the fair value accounting victory pretty hollow.
But relief came.
Relief arrived via interim guidance from the Treasury and the IRS on September 30, 2025. And this guidance allows the exclusion of unrealized gains and losses on digital assets from the calculation of AFSI.
And the significance of this is just immense. It's almost transformative.
It is. Management now states they no longer expect to become subject to the 15% CAMT due to these gains. This essentially removes a massive multi-billion-dollar tax overhang that could have severely penalized them for adopting the standard in the first place. A huge win for the Treasury strategy.
Okay, let's talk capital strategy and market risk in 4.2. Management isn't just continuing their strategy, they're accelerating their ambitions exponentially.
They detailed a new medium to long-term plan to raise $84 billion.
$84 billion. That is an exponential leap from their prior target of $42 billion.
It is. The new plan breaks down evenly. $42 billion of equity capital and $42 billion of fixed income instruments. This massive target indicates they are fully committed to scaling their Treasury strategy to an almost unimaginable degree.
It signals an intent to potentially become the dominant public Bitcoin proxy globally.
But the market's view of this aggressive leveraging strategy is tempered by their credit rating.
Right. S&P Global Ratings assigned them a corporate credit rating of B on October 27th.
Which is explicitly a below investment grade rating.
B is often called highly speculative. So while they've successfully raised billions so far, this rating signifies inherent financial leverage risk. It means future financing access could be impaired or become prohibitively costly, especially if market conditions sour.
It introduces real limitations on who can hold their debt and preferred stock. It restricts their pool of potential investors.
Regarding liquidity and BTC holdings, management says they don't anticipate needing to sell any of their Bitcoin in the next 12 months.
They do, but the risk factor disclosure is essential reading. BTC is highly concentrated, less liquid than cash, and subject to extreme volatility.
And the filing highlights this reality, noting that Bitcoin traded below $60,000 and above $120,000 in the 12 months prior to September 30th.
That kind of range means the $73 billion asset base could easily fluctuate by tens of billions of dollars every quarter.
And they operate with minimal cash reserves. Their cash and equivalents only increased slightly to $56.2 million. They have no significant buffer.
They dedicate almost all raised capital to Bitcoin acquisitions, running the business right on the edge.
Finally, in 4.3, let's cover the legal and corporate governance updates. The complexity and velocity of their capital raising inevitably creates some housekeeping issues.
And legal challenges, yeah. First, on the historical side, the Brazil matter is resolved.
This was about historical procurement issues at a Brazilian subsidiary.
And it's been fully resolved through some minor payments. About $1.1 million paid in July 2024 and around $406,000 paid in April 2025. It's a clean resolution.
On the shareholder action front, they had a win with the dismissal of the consolidated Chen Parmar derivative actions on September 10th.
So that removes a layer of litigation. But a new legal challenge has emerged. The Dodge class action filed in July.
And this one alleges a violation of the Delaware General Corporation Law regarding the STRK amendment.
Right. The STRK preferred stock liquidation preference was changed, and the lawsuit's core argument is that common shareholders were allegedly entitled to vote on that change. If this were to succeed, it could create difficulties around the structure of that preferred stock.
Okay, there's also an update on D&O insurance.
Yes, the company increased its directors and officers liability insurance to $120 million in aggregate coverage.
And this seems like a small detail, but it allowed them to eliminate the need to extend the 2023 tail agreement with Michael Saylor,
which effectively formalizes the transfer of D&O risk exposure away from a related party arrangement to third-party insurers, a good governance move.
And finally, a very telling piece of corporate cleanup.
The ratification of preferred shares under DGCL Section 204. It's a highly technical but fundamentally important. The company disclosed that the issuance of specific shares of STRK, STRF, and STRD between March and July needed ratification because they missed filings of the certificates of increase for the preferred stock series. This is not just minor paperwork. It implies serious corporate housekeeping errors that could have potentially legally jeopardized the validity of those prior issuances.
Which raised billions of dollars.
Billions. Specifically, over 5.4 million shares of STRK, 2 million shares of STRF, and nearly 190,000 shares of STRD were ratified, and they had to do a subsequent ratification for another 444,000 STRD shares sold later.
This post-facto cleanup just highlights the almost frenetic velocity and complexity of their capital raising.
They're operating so fast and raising so much capital that they are sometimes tripping over the regulatory filings required to keep pace.
So this Q3 filing is really a powerful testament to the success of this leveraged Treasury model, especially in favorable market conditions. Coupled with that critical regulatory relief on the CAMT, the capital engine is running faster than ever.
So to synthesize the core financial thesis, Strategy Inc. is successfully executing an unparalleled capital deployment strategy. It's raising massive amounts of structured capital through 6 series of debt, 4 complex types of preferred stock, and continuous equity ATMs, all to finance the perpetual accumulation of Bitcoin.
And this strategy has resulted in reported net income of $8.588 billion year-to-date, driven almost entirely by those non-cash unrealized BTC gains, which were enabled by the new fair value accounting standard.
And simultaneously, the traditional software business is paying the price of supporting this engine. It's managing a challenging but necessary cloud migration, showing massive subscription services growth of over 65% while seeing declines in legacy support.
And it's using deep cuts in operational expenses, specifically R&D and S&M, to effectively turn the software segment into a high-efficiency cash cow. It's designed to sustain the cash liabilities of the Treasury, like the $5.3 million in quarterly custody fees and those massive preferred dividends.
The key takeaway for you, the investor, is the BPS metric. At 199,984 Satoshis per share, management is succeeding in its goal of maximizing physical Bitcoin exposure relative to dilution.
But, and it's a huge but, this success comes with immense structural risks, an $84 billion future capital expansion plan, and a B credit rating that signifies high leverage risk.
All dependent on continued favorable market momentum for Bitcoin to sustain the massive debt and preferred stock financing structure. The question remains, can this leveraged perpetual motion machine survive a long, harsh crypto winter without being forced to liquidate its core asset?
With that, we conclude our coverage for this video. Thanks for joining us. Sheen Research. Mindful Markets, Measurable Meaning.